hovering over you.
You're welcome. Thanks for coming today. So just a couple CFA Cleveland topics first. Next week we have our last event of 2017. It is going to be a holiday happy hour at over at Sabreo Bravado, which is, so they took over one of the big theaters behind them, and you can have private parties there. So we're going to be doing it there. It is free for everybody. Feel free to bring guests. We'd love to have more people come. And Terry Jenkins is coming from BlackRock, and it's just going to be kind of an interactive conversation about, the end of 2017, what's coming in 2018, and if anybody was there for our forecast event last year, Terry was there, and he's a good interactive speaker, so it should be a fun night, so please join us. On the back of here also is the events that we have scheduled so far. There's a couple still to be added. We'll kick off 2018 January 24th. We're very excited. We have Dan Fuss from Loomis Sales is coming. That also will be our Charter Awards lunch. And if you are here and you're a new charter holder, look for an invite in the next week or so with all the details on that. And then there's a list here of everything else we have going on. Like I said, we've got a couple events that aren't on here yet, but we've got a great schedule for 2018. So I want to welcome Michael. Thank you for coming. He's one of the world's leading experts in the fields of international economic forecasting and global political risk analysis. And we want to welcome Michael to Cleveland. Thank you. He's coming home to Cleveland.
Home, right.
Yeah, he grew up here, although he lives in Europe now. So thank you.
You get to have lunch while we talk about the global economy. That maybe isn't the best mixture. Was anyone there? I spoke last night at the Cleveland Council on World Affairs. Was anybody there yesterday? No, good. I can recycle my jokes then from last night. Perfect. We have to make this a little bit lighthearted. There's so many serious topics to talk about. Now, we have about 45 minutes. I'm going to go around the world, and we're going to look at some of the key issues facing the global economy and geopolitics as we move into 2018. If you've seen me speak before, the agenda for this is the same. We've been doing the Global Economic and Risk Outlook now for 14 years. We present it all over the world. What we do is we look at the world in 2017, the previous year, to see why we are where we are. Then we're going to look at the global economy, some big picture topics, some overlying topics in 2018. We're going to look at some geopolitical issues, some key issues and trends, and then, time permitting, we're going to go region by region and look at the performance of individual economies in those regions. That's time permitting. Now, in this presentation, there are lots of charts, there's lots of data. We will be sending you a copy of the presentation. So if you missed something, don't worry about it, you'll get a copy. There's a lot of information. And at the end of the presentation, my email address should be up there. If you have any questions that you didn't get a chance to ask today, by all means, feel free to contact me. So, let's get into this. The global economy for the last 6 years has been growing at a rate of just above 3% per year. That's the most sluggish performance, prolonged sluggish performance for the global economy since the early 1990s. Now, we haven't had a deep recession globally since the financial crisis, but growth rates haven't rebounded to the levels that they were at before the financial crisis. Now, this year, we've seen a little bit of a pickup, but still the global economy is forecast to grow at about 3.4, 3.5% when all is said and done in 2017. That is still significantly below the rates before the financial crisis. Now, since the financial crisis, there's been a really big divide between developed economies and emerging economies. Before the financial crisis, most of the growth generated in the world was being generated by developed economies. They were much larger, they were growing at a decent rate. Since the financial crisis, most of the world's developed economies have had a real tough time getting back to the levels of growth that they had before the financial crisis. And you can see from the chart there, that's overall growth for the world's developed economies. And you can see in the 21st century, developed economies have grown at an average of less than 2% per year now for 17 years. That's half of where we were at just a couple decades ago. It's a major shift in the global economic balance of power. And we're seeing this across all the developed economies. In North America, now this is the Donald Trump version of North America. Mexico's been left out, but it's just the United States and Canada when we talk about the developed economies. They've done better on average the US and Canada than their developed counterparts elsewhere in the world. But as you know, the recovery here in the US has been relatively sluggish. Again, growth rates not where they were at prior to the financial crisis. Now this year we've seen some decent growth in the middle of the year. The first quarter, once again, was disappointing. We do have an issue in the United States. 4 of our last 5 first quarter results have been very disappointing. Initially that was passed off to weather-related issues, but now we're looking, is there something more cyclical that we're not seeing? One interesting stat I want to mention, the United States economy hasn't grown by 3% per year for an entire year in 11 years. Hasn't happened in 11 years. That has not happened throughout the entire history of the United States. It's the longest stretch of below 3% growth that we've had in US history. Europe suffered 3 separate recessions in the wake of the global financial crisis. And when I was doing these presentations around the world in previous years, didn't have that many positive things to say about Europe. The focus was always on improving their export competitiveness. And what happened in 2014, the euro and some other currencies in Europe fell pretty sharply. And that led to an export-driven recovery in Europe. We're seeing growth now in Europe just above 2%. Europe, in fact, this year may outgrow the United States for only the 6th time in the last 26 years. So we've started to see a more broad-based recovery in Europe. Now some economies doing better than others in the region. Germany's been doing pretty well on the back of exports, whereas Southern Europe, yes, things are starting to improve in Southern Europe, but growth rates in places like Italy and France remain well below their counterparts in other parts of Europe. Developed Asia Pacific, that's Japan and Australia, South Korea, Taiwan, Hong Kong, and Singapore. Japan, of course, now for 25 years has grown at an average of less than 1% per year. Now there are a number of reasons for that. Demographics, the Japanese population is shrinking faster than just about any population in the world. Their competition for exports from other countries in Asia and elsewhere around the world. It's resulted in Japan having a very difficult time for the last 25 years. Now this year it's improved a little bit. We're estimating growth at about 1.5, 1.6% for Japan this year. That's a very good rate by Japanese standards. So developed economies since the financial crisis not generating that much growth. Yes, there's a recovery underway, but it's a relatively tepid recovery. Where's more and more of the growth coming from? Of course, it's emerging markets. But in emerging markets, what's happened is, in the wake of the financial crisis, emerging markets across the board were growing. Everybody was growing. Commodity prices were high. That was driving growth in places like Latin America, the Middle East. Asia, of course, was growing at a tremendous pace. But in recent years, we've seen a definite divide between the haves and the have-nots in terms of emerging markets. The haves pretty much are in Asia. The have-nots are everywhere else. As you can see, China, of course, leading the way. Chinese growth this year is estimated to be about 6.8%. For the year. That's a little bit better result than was expected at the beginning of the year. And keep in mind that 6.8% growth being generated in China in 2017 is contributing more growth for the global economy than the 14% growth that China achieved 10 years ago. Because the Chinese economy today is so much larger than where it was a decade ago. It's the 2nd largest economy by most measures and will overtake the United States in terms of economic output sometime in the next decade. Now we're going to talk about some of the forward-looking issues with China and some of these other markets going ahead. But right now we're just looking at where we've gone so far this year in 2017. India. Now India had overtaken China to become the fastest-growing large economy in the world. However, they've had a difficult time in 2017. They took 86% of their banknotes out of circulation. They introduced the new goods and services tax. That's resulted in growth of only about 6%. Now, you say only 6%, keep in mind the Indian population is growing at over 2.5% per year. So China's population is growing extremely slowly because of the one-child policy. And in contrast, India needs higher rates of growth to reduce poverty levels because of the high population growth. The other big part of the Asian emerging market puzzle is Southeast Asia. It tends to get overlooked in between the giants of China and India, but there's 660 million people living in Southeast Asia. Some of the fastest growing economies in the world are found in Southeast Asia. This is one of the key centers of trade and investment in the 21st century. Economies like the Philippines, Indonesia, Vietnam, recording growth rates in excess of 6, even 7%. So some of the fastest growing markets are right there in that other part of Asia. So Asia, it looks pretty good. We're talking about growth rates of 5, 6% among emerging markets. However, for the rest of the world's emerging markets, the last couple of years have been very difficult. We'll start with the Middle East and North Africa. Those economies in this region that are relatively diversified, places like Israel, Turkey, Egypt, they've been growing at a decent rate. However, those economies that are dependent upon oil and gas exports have been struggling since the oil price fell in 2014. And keep in mind, a lot of those countries were spending, government spending in those countries was tremendously high. And suddenly, oil revenues were cut in half overnight in those countries. So they're running some of the biggest budget deficits in the world in a number of the countries in this region. Same holds true for sub-Saharan Africa. This was expected to be the region that would one day overtake Asia in terms of economic growth. That hasn't come to fruition in recent years. Too many countries, too many of the most important economies in this region are dependent upon one or two commodities for export. And commodity prices, not just oil and gas, but agricultural, mining, prices in those sectors have been depressed now for over 3 years. Latin America has been the worst performing region of any major region in recent years. You can call it the Cleveland Browns of regions. I hope you didn't invite any Browns executives here, because I'm in big trouble. I have more Browns jokes. Latin America's been doing quite poorly, and again, there's a number of reasons for that. Some of the most important economies in that region have struggled. Brazil, the largest economy in the region, just came out of a recession in which economic output fell by 10%. Venezuela, of course, which was once one of the richest countries in Latin America, has seen its economic output fall by almost 40% in recent years. The inflation rate, nobody knows what the inflation rate is in Venezuela, but it's believed to be at least 2,000%. They just released a new cryptocurrency called the Petro. If you're interested, if you couldn't get in line for Bitcoin, you can invest in Venezuelan cryptocurrencies. I'm sure they're very reliable and safe. And then, of course, Mexico. Now, I'm going to talk a little bit more about Mexico and NAFTA going forward, so I won't talk too much about them now. But what the overriding story is that Latin America has been very disappointing in recent years after some very strong growth rates earlier in the decade. So that was a quick view of the regions around the world, why they are where they are. Trade and investment, the one thing I would take away from this is that prior to the financial crisis, trade and investment growth rates consistently exceeded economic growth rates on an international basis. Since the financial crisis, that is no longer the case. And what that tells me is that businesses and investors, yes, stock markets are at all-time highs around the world, but there's still a lack of confidence among many businesses and investors in many of the key markets around the world, and that's why we're seeing depressed levels of trade and depressed levels of investment. Currencies, the chart on top got a little bit mixed. What it shows is the change in major currencies against the US dollar. The first one on top shows it since the beginning of this year. Now, all major currencies have appreciated to some degree against the US dollar in 2017. That's a boost for US exporters. However, if we go back to 2014 and compare where the currencies are today, all of the world's major currencies are still relatively weak against the US dollar. That says that there's still room for the US dollar to weaken. There's still more competitiveness to be gained by US exporters in terms of currencies. And this, of course, is the leading tool for a country when it's trying to improve its export competitiveness, particularly at a time when many of these key countries have relatively weak levels of domestic spending, both business and consumer. We talked about commodity prices. They remain relatively low. We've seen some increases in 2017, but not so much. One interesting thing is that, look at the oil price. The oil price, we had this year a deal reached by OPEC and Russia and a couple other oil-producing countries to cut output with the hope that that would really boost oil prices. But it's barely pushed them up there. Why is that? It's because of here in the United States, the shale oil industry. There's so much oil being produced in the United States now that anytime the price goes up a little bit, production goes up in the United States and the price is pushed back down. And that's a trend we think is going to continue for the foreseeable future. We've seen estimates that 80% of the new oil production in the world over the next few years will come from one country, and that's the United States. As far as geopolitical developments, of course, this has been a year heavily influenced by President Trump. The United States has become, to a degree, a more inward-looking country with an American first policy. Now, that hasn't weakened America. I think that's being overstated when you see articles that America is suddenly a weak country. But what it does mean is that the most powerful country is now a country that is not as engaged on many issues internationally, ceding the initiative to many other countries, particularly China on issues like climate change, trade and investment, security issues in Asia. We've seen China take a more assertive role as the United States has taken a lesser role. The conflicts in the Middle East, in North Africa, in Central Asia continue. They've been continuing for a number of years. They show no signs of abating. Sometimes the sides change, sometimes someone loses and a new rebel group or a new government pops up, but conflicts in places like Syria, Iraq, Yemen, Libya, potentially in Lebanon, continue and will continue going forward. 2017 wasn't the dramatic year of elections that 2016 and some of the previous years were. Most of the key elections were found in Europe. One trend that we see, and we're continuing to see, is the rise of left-wing and right-wing populist parties and leaders across democracies. And that is making it increasingly hard for governments to govern. We see in presidential elections many qualified candidates no longer having an opportunity as populism on the right and left takes hold, and in parliamentary systems, it becomes increasingly difficult to form governments. And we see that repeatedly in Europe, where there are 10 to 12 or 14 parties sometimes are entering the parliament, many of them now on the far right or the far left. It makes it very difficult to form stable governments. So this rise of populism, of nationalism, of protectionism is really posing a significant threat to democracy in many parts of the world. We talked about the conflicts. So a quick summary of 2017, growth picked up a little bit, not to the extent that many would have hoped, but risk levels remain relatively high, and we'll talk about some of those going forward. So let's look at 2018 and beyond. What are some of the key issues that we're looking at? Now, there's been some momentum, particularly in the second and third quarter around the world. But since the financial crisis, the global economy has not been able to maintain any momentum. We've had periods before of 3, 6, even 9 months where growth appeared to be picking up, only for it to lose steam again. Can 2018 be the year where we actually realize some sustained healthy growth? Inflation could become an issue in a number of key economies around the world. Now, in recent years, we were talking more about deflation than inflation, but we're starting to see inflationary pressures emerge in some parts of the world. The emerging markets outside of Asia, they've been performing very poorly. Is this the year they turn things around? Commodity prices, are they going to stay low? And protectionism, is that a trend that's here to stay for the foreseeable future? As far as our forecast for the global economy, we are predicting growth rates to hold relatively steady. Now, this masks, of course, some changes in individual countries, which we'll talk about later, but the growth rate overall is, we're forecasting in the upper 3s, 3.6, 3.7 over the next 3 years. That's pretty much in line with the IMF and other major forecasters. Where's the growth going to come from? That chart there is an interesting chart. It shows which country is, what the share of each country or regions, what their share is of the global growth that will be generated in 2018. As you can see, China will generate 36% of the growth and economic output in 2018. China and the US for a number of years were neck and neck. China is now clearly the leading driver of economic growth. The United States and Canada in second, Europe in third. Asia accounts for about 50% of the contribution to global economic growth next year. If you take Asia and developed economies, so West Europe and North America, it's over 92%. So the rest of the world, besides the developed regions and Asia, are only accounting for about 8% of global economic growth in 2018. And that's a scenario we've seen over the last couple of years, that certain markets you're realizing strong growth, elsewhere struggling mightily. Growth ceilings. For the Cleveland Browns, growth ceiling is 2 wins per year, and then they overheat and explode. They haven't reached it in a couple of years. For an economy, a growth ceiling is when the economy starts to run into, it starts to overheat, you start to get inflationary pressures, you get labor shortages, you get asset bubbles. The growth ceilings in most of the world's leading economies have come down in recent years. Before the financial crisis, you could argue the growth ceiling here in the United States was about 4.5%. I mean, the US in the 90s, for example, recorded consecutive years of mid-4s growth comfortably. Europe also, into the 1990s, was able to record growth of near 4%. It's come down significantly. We see now growth ceilings in, let's say, the new world economies, places like the US, Canada, Australia. We think the growth ceiling right now is down to about 3%. Yeah, we're already seeing labor shortages in a number of sectors. We haven't gotten there yet. Europe's butting up right against their growth ceiling now, and if you look at places like Germany, they have a significant issue with labor shortages and growing fears about inflation. So they're really, some of the European economies are right at their growth ceilings. This is a major change. This is a major reason why growth isn't what a lot of countries had hoped for. And why is that? Well, demographics, working age population is shrinking or stagnating in many of these economies. Productivity growth has been disappointing at best in recent years. So the opportunities for these traditionally strong economies to record higher rates of growth just aren't there anymore.
Are you saying that the growth ceiling is kind of correlated to full employment in that specific country?
That's one correlation, absolutely. So what is our outlook for developed economies? We're predicting a decent 2018. We think the US economy is going to do pretty well in 2018. Europe will continue to grow, maybe a little bit slower in 2018, but will remain relatively solid. We're looking at 2019 as the year where we start to run into some headwinds in terms of domestic demand, in terms of share prices. But the near-term outlook remains pretty strong for most of the world's developed economies. As far as emerging markets are concerned, there's some interesting developments we'll talk about. Growth is going to pick up in a few regions, but it's going to be relatively anemic. India is certainly going to bounce back from a difficult year. China is going to start slowing. This year, China didn't do much about their debt problem. We're going to talk about that in a little bit, because they had the Congress and President Xi wanted to make sure he kept his grip on power. That's behind him now. He's firmly in charge. He can now start to make some tough decisions on how they're going to tackle the debt issue, the real estate issue, some of the bubbles that exist in China. Same with foreign investment. I'll skip through a couple of these because we have a lot we'd like to get to. NAFTA, that's one thing I would like to talk about. Now, it is hard to gauge what President Trump's going to do. I should have checked Twitter before I came in. I didn't. I should remiss that I didn't. But there's one thing that he's been kind of consistent on, is when he makes an aside at the end of a statement, he tends to mean it. And when he talks about NAFTA, he talks about how well the negotiations are going and they're making progress. And he always says at the end, but I'm probably going to scrap it anyway. So that tells me that there's an inclination in the Trump, for President Trump, perhaps within his administration, to get rid of NAFTA. Now, he's facing a lot of opposition. Farmers in Iowa who sell a lot of corn to Mexico are very angry. The energy sector is very angry. The automotive sector is coming together to fight this. So a lot of those states that voted for Trump in 2016 are coming out and saying, don't even touch NAFTA. This is a key part of our economy. And what's his rationale for doing so? He talks about the trade deficit, right? That we have a trade deficit with Mexico and it's all because of NAFTA. But what's going to happen if we scrap NAFTA? We can only impose tariffs, maximum tariffs that the WTO would allow, because we're both members of the WTO. In fact, studies show that the average tariff of Mexican imports to the United States would only go up by 3.7%. And what's going to happen to the peso if Mexico gets kicked out of NAFTA? It's going to go down 20%. It's going to go down 30%. Investors are going to pull out of the peso. So a Mexican manufacturer is going to be a hell of a lot more competitive with a cheap peso and only a few more percentage points of tariffs slapped on their goods than they were staying in NAFTA. We're going to see an even bigger increase in the trade deficit with Mexico. So this is why so many economists and so many business leaders are screaming against this proposal to pull out of NAFTA. Exchange rate forecast, we're not forecasting too many big shifts in terms of exchange rates. A couple worth mentioning: the Chinese yuan. We're expecting the Chinese government to start to take some steps to rein in lending in order to get the debt situation in that country a little more under control. So we do expect the yuan to depreciate. They're going to allow it to depreciate not too much, but 5 or 6%. The two currencies we're watching closely: the British pound. If the negotiations over Brexit collapse, or if they don't go well, we could see a sharp fall in the pound. And then, of course, the peso, like I mentioned. There's a better than 50% chance we're going to pull out of NAFTA, and that's going to have a big impact on the peso. Commodity prices, we're not looking at any major increase. I think the only thing that could lead to a big increase in oil prices, for example, is a full-scale war between Saudi Arabia and Iran, which, unfortunately, the odds of that have gone up in recent months, but that's about the only way oil prices are going to go up significantly. So I won't talk too much about this. We mentioned that. A couple geopolitical issues that maybe we're watching. We talked about the threat to democracy. China, of course, is a rising economic and military power. This is causing great alarm among China's neighbors. China's neighbors looking increasingly to the United States, but the United States, of course, looking increasingly inward. This is having a huge a shift in terms of the balance of power in what is now the world's most important region. I'm going to go through a lot of this because I'd like to go region by region. We've talked about Donald Trump, China's ambitions, China and India. This is an interesting case. These are the world's two most populous countries. Almost 2.8 billion people live in the two countries. They don't get along very well. They have a lot of border disputes. There's a lot of economic tensions between the two sides. There was some clashes along the border in the Himalayas between the two this year. This is a relationship that bears watching. These are the two countries that will join the United States as major powers in the 21st century. China already has. India's on its way there. And that relationship is something we watch very closely. I didn't talk much about North Korea. Our opinion is North Korea is following they saw what happened to Gaddafi in Libya. He turned in his nuclear program, turned it over, and he was dead within a couple of years. They want to make sure they have that threat in their back pocket that if you attack us or you try to take us out, we can hurt you before you do. And that's why they're going as fast as they can to develop long-range nuclear missile capabilities, and they have not stopped testing. Now, China has not put enough pressure on them. The only country that can really do something about this is China. They could shut their economy down overnight. They haven't done enough. Trade levels with China continue to go. They continue to buy coal from North Korea. They continue to supply electricity to North Korea. We talked about the wars in the Middle East already, the Mediterranean, Saudi Arabia. I'm going to go through these pretty quickly because I want to get to the regional sector. There's a couple of key issues I want to talk about first. Hold on. Protectionism. This is a trend that is growing not just here in the United States but around the world. People feel like they're being left behind by globalization. So many businesses are suffering or believe they're suffering at the hands of foreign competition. We're seeing an increase in support for protectionist parties and political leaders on the right and on the left. We're also seeing a proliferation of walls and borders, at least proposed ones. Now, we don't believe that the wall on the US-Mexican border is going to be built. I don't think many people do. But nevertheless, borders are reappearing or are being strengthened in many parts of the world, not just along the Rio Grande. And that's something, again, that's a potential disruption for the global economy. The increase in borders, or at least the making it harder to cross borders, stifles innovation, stifles trade, stifles investment, stifles the flow of labor, and that could have a major drag if this trend continues on the global economy. At the same time we have protectionism, we have aging populations. And what that means is the working age population in many of the world's leading economies is stagnant or shrinking. In Europe, in Japan, it's shrinking dramatically. Even in China, it's shrinking. China had a one-child policy for almost 4 decades. They just scrapped it last year. That doesn't mean there's going to be a major increase in the number of babies being born in China. So almost all of the world's leading countries have working age populations that are shrinking. That's a major drag on growth. That's shifting voting patterns in a lot of countries. And that's something we're watching going forward. So as the population ages, what happens? A lot of companies are turning to automation to make up for the lack of workers. Think about trucking companies, for example. They can't find truck drivers here in the United States. They can't find truck drivers in places like Germany. They're clamoring for driverless vehicles to be developed as quickly as possible. In factories, here's a good example from Germany. Adidas, they didn't make any of their shoes in Germany. They're based in Germany. They built a factory there. It was a big deal, but they only hired a couple people to work in the factory, a couple janitors, a couple security guards, and a couple people to turn the robots on and off. So they're building shoes again, making shoes again in Germany, but they didn't really create many jobs doing that. And that's what we're seeing over and over in developed economies. A lot of people are blaming foreign competition for the loss of manufacturing jobs. But the number one reason is automation. And if factories and manufacturing do come back to the United States or to Europe or to Japan, they're going to be in very automated forms. They're not going to create the type levels of jobs that they did a couple decades ago. I mentioned the rise of the over 65, the population is getting older. But look at the rise in the number of people over the age of 65. In developed economies, it's going to grow by about 130 million, or about 60% over the next generation. But in emerging markets, it's going to grow by 300% over the next generation. This is the one growth market that's guaranteed to be there in the coming years. Products and services aimed at people over the age of 65. The guaranteed growth market. At the same time, we're seeing this protectionism trend spread, cities, states, regions, they've become the champions of trade investment in many cases. We see that here in the United States, we see that around the world. That cities, they realize the benefits of trade and investment. Most of the opposition to trade and investment are not coming from the largest cities in countries. They're coming from rural areas or depressed former manufacturing centers. And some of these cities today are unbelievably big in terms of economic output. Tokyo, if it were a country, would be the 10th largest economy in the world. New York City would be the 12th largest. These are huge centers of economic output. They have tremendous influence, and in many cases they're now clashing with their national governments, who are taking a much more protectionist, nationalistic line, as opposed to cities who want to be open to the world. They want people to come to those cities, they want investment to come to those cities, and they want their services and goods to be exported around the world. That's a big clash we're seeing all over the world right now. Debt levels, of course, this has been a big issue for many countries in recent years. I highlight China because that's the one we're really watching closely right now. That shows total debt, so that's business debt, consumer debt, and public debt. Chinese debt level, that means Chinese overall debt is over 300% of their economic output. That is a dangerously high level for any economy, let alone an emerging market. And the government knows it. They're fully aware that this problem exists. I don't think they did anything because the major party Congress took place late this year. I think we're going to start to see the Chinese government rein in lending in 2018. It's going to reduce consumer spending somewhat. Now, consumer spending has been the key driver of growth in China. It was always manufacturing output that drove growth in China. Increasingly, it's consumer spending. Consumer spending levels growing over 10% per year still in China. But if you start reining in lending, that's going to get cut. That's why we're going to see some downwards pressure on the currency there going forward. But that's a huge issue to watch in the coming year. The tax plan, we put this in since they passed a late night deal in the Senate. The one thing I'll say about this, there's no serious economist out there who believes that the cost of the tax cuts will be recouped in higher rates of growth that generated by the tax cuts. Most of the estimates that we have and that we've seen estimate that around 1/3 of the cost will be recouped by higher growth. There was a consensus for corporate taxes to be cut, but what's going to happen with that money that companies are saving? That's a big question. For example, one of the things that we liked last year in the campaign was this talk of an infrastructure bank, where a lot of the foreign funds held by companies would be invested in infrastructure in the US. We haven't heard anything about that lately. And we would like to see, if you're going to cut taxes, where are these companies going to be investing that money? Are they going to be investing back here in the United States? Are they going to be investing in projects, infrastructure projects, job creation projects here in the United States? That remains to be seen. And until we have an answer, it's very hard to make an accurate assessment of what exactly the impact is going to be, besides the fact that it is going to raise the budget deficit in the coming years. I won't talk too much about this, just quickly. Prior to the Industrial Revolution, we're going way back now, Asia accounted for over 50% of the world's economic output. And by World War II, that shrank to about 10%. It's coming back, and that's why we see Asia again generating so much of the world's growth, the huge population, the high levels of population growth in Asia, increasingly becoming the center of world economic output. Again, there's so many charts here. Don't worry, you'll get a copy of this. And then these are just our forecasts for 2050. You think the Browns will win a Super Bowl by 2050? You know, smart people, they invested, like years ago, smart people invested in Bitcoins, and the less smart people, like myself, put money aside to go to a Super Bowl one day to see the Browns. I regret that decision terribly. So we've got about 10 minutes, so good. We can just go, what I do here is we just go region by region. We'll start here, go around the world, and just have a look at a couple of the issues facing individual countries or individual regions going forward. We talked about North America. I didn't say much about Canada, but Canada's done pretty well this year. They've bounced back. They were hit pretty hard by low commodity prices. But Canada's one country that did not suffer a recession after the financial crisis. They're one of the only developed economies in the world not to. Australia, Canada, and one or two others. That's about it. So they've done pretty well this year. They've come back. We talked about state and local economies already. And as far as elections we're watching, of course, there's the midterm election in the United States coming up. The The interesting thing there, clearly the Democrats are poised to make gains, but it's going to be very hard for them to take control of the Congress just because of the number of seats they're having to defend, particularly in the Senate. There are 34 elections, I think 23 of them are Democratic seats. So it's going to be very hard for them. They can gain a majority there. They're 40 seats behind in the House. It's going to be difficult for them to gain control of the Congress, though they will, as it looks right now, and we're still 9 or 11 months away, like they will make some gains. Latin America, they've been struggling. As I said, we're going to see a recovery. It's going to be relatively tepid. It's not going to be a return to the growth rates they had earlier in the decade. That's because we don't have, we're not forecasting major commodity price increases. Domestic demand levels are not growing as high as had been hoped. Brazil, as I mentioned, has been in a deep recession. They have an election next year. Their president's approval rating is 3%. Michel Temer has a 3% approval rating. And that's about Hugh Jackson's approval rating right now. But 3%. Imagine, I mean, Donald Trump's is averaging about 37.5% right now, and he's being told how low his approval rating is. Michel Temer in Brazil has a 3% approval rating. And as you can see, that chart just shows, that just highlights the struggles they've had, how poorly Latin America's performed vis-a-vis other emerging markets. I spoke in Mexico City a couple weeks ago, and I did one of the presentations was just on Latin America, and it was mostly a Latin American crowd. And I was very happy they had a fully stocked bar there because I had not that much nice to say. And I was encouraging people, please get a drink. It'll sound a lot better as we go forward. And it will be the year of the election in Latin America in 2018. There are a huge number of elections taking place. The cycle's already started in Argentina and Chile. There's a lot of key elections, Brazil, Mexico. Now, Mexico could be voting for a left-wing populist, Lopez Obrador. He's lost a couple of elections there in recent years. He's currently leading in the polls. And if, let's say, Trump decides to scrap NAFTA in early 2018, that's going to be a big boost for his campaign because he has been, from day one, the anti-Trump candidate. So we could have Donald Trump in office in Washington and then his opposite, a left-wing populist, in office in Mexico City. That could really lead to an even greater deterioration in relations between the two sides. West Europe, as I mentioned, West Europe's done better over the last 24 to 36 months. It's done better than it's done at any time in the last decade. There's still, for some of the southern countries, a little bit room for growth, but the northern economies running into inflationary pressures and labor shortages in many cases, and that's going to really act as a brake on growth going forward. These are countries almost across the board that are dependent upon exports for growth. So the weaker euro in recent years has helped. That's helped to boost domestic demand now that we've had a couple of years of growth, but domestic demand is constrained by, again, shrinking working age populations, relatively low rates of growth. So for Europe to grow, it needs to continue to export, it needs to be competitive in terms of exports. Brexit, I didn't talk much about that. The negotiations between Britain and the European Union on Britain's withdrawal are ongoing. They're not going so well. There's a couple of big issues over how much Britain should pay for leaving, and the border between Northern Ireland and Ireland. But that's something that bears watching over the next year. They need to be finished by April 29, or else Britain might just walk out without a deal in place. And it's a similar situation to Mexico. If Britain would leave, the pound would certainly fall significantly, but that would then probably be a nice boost for British manufacturers. And the British manufacturing sector has not done that well in recent years. Central and East Europe, some Central European economies, places like Poland, Romania, Hungary, have done extremely well this year, and that's because of the increased demand for exports in West Europe. Their economies are so tied to Germany and France and other parts of Europe that when they do well, Central Europe does well, and vice versa. Now, in East Europe, and by East Europe we mean places like Russia, Ukraine, situations have been much different. Russia, of course, hit by low oil prices, by sanctions, Ukraine by conflict, so that part of Europe has done very poorly. You have a big divide between exporting economies in Central Europe, manufacturing economies, and commodity countries like Russia further east. Of course, there's a presidential election in Russia next year. We all know who's going to win. That's pretty clear. They barred most of the serious opposition candidates from taking part, but they have a woman, I forget her name, Ksenia something, but she's called the Paris Hilton of Russia. They've approved her as the opposition candidate. So I think Putin is going to find himself winning rather easily. And now that Russia's been barred from the Winter Olympics, that just plays into Putin's hand. I talked about the Middle East and Africa. The low oil prices have had a major impact. There's that spike in growth in 2016. That's Iran driving a lot of that, because the Iranian economy grew by 13% when sanctions were lifted in 2016. There's also Turkey did pretty well. But overall, oil prices have really been a big drag on these economies, and that's not going to change much going forward. Of course, this is a region that needs to create jobs, because the population growth in the Middle East and North Africa is among the highest in the world. And why do you see immigration pressures like we saw in Europe in 2015? Is because there's no jobs there. Yes, you have the conflicts in Syria and Afghanistan pushing people that way, but you also have the lack of jobs for young people also pushing people to markets or countries where they think they can find a better future. And that trend's going to continue. Birth rates in this part of the world among the highest in the world. Sub-Saharan Africa, similar situation, very high rates of population growth, very low rates of job creation. Too many countries in the region remain dependent upon exporting usually one or two commodities to richer countries. Some parts that are more diversified, like East Africa, for example, have done pretty well. But places like Nigeria, Angola, all those oil-producing countries, they've really struggled. And South Africa has struggled mightily as well. It's a country we've done a lot of business with in the past. They have real big problems. This was the most developed, most advanced economy in Africa by some margin. They have really fallen on hard times in recent years. And the same thing here, population growth bears watching. Africa is going to create, and that, if I see that chart properly, 700,000 new people in the global working age population within a generation. 700 million, I forget what it is, 700 million. That's an incredible number of potential workers, potential consumers coming from one single region. But if there's no jobs being created, if the economies aren't being developed and being diversified, that's a huge potential risk as well. This is a region that sees too much conflict, too much internal strife, because many of these countries were artificially drawn by their European colonialists. And if the economy does not pick up in this region, there's a huge potential for major unrest there and spreading elsewhere looking forward. So I'll just go through that. Central and South Asia, this of course the region dominated by India. Very strong growth rates forecast, not just for India going forward. India, we're looking at getting back to 8% growth within the next 18 months. But also in places like Pakistan, Bangladesh, Sri Lanka, very strong rates of growth. Huge populations. People don't realize that Pakistan has about 200 million people. Bangladesh, 170, 175 million people. These are very big countries, very big potential markets. And they will see more and more investment and trade as we go forward. And some of the state and people, when you look at a country as diverse as India, you really need to look at where you're investing. And it's not to say we're going to invest in India. There's such a diversity among the states. You have states that are growing and have recorded double-digit growth for year after year, and you have others that are growing very slowly. It's not like China. When Beijing said we're going to do something, the country did it. When New Delhi says we're going to do something, the state governments flip them off and say, no, we're going to do what we want. The state governments have a lot of power, a lot of influence. And many key states in India have governments that are very hostile to trade, economic reform, and foreign investment. That's been one of the reasons India hasn't been able to develop the manufacturing sectors that China did in previous years, because China said, we're going to build this road and nobody's going to stop us. It's a much different situation in India. And then again, East Asia, Pacific, very diverse region. You have very wealthy countries like Australia and Japan. You have developing economies like Indonesia and the Philippines. This is still the center of growth. This is the region that's going to account for about 45% of growth generated in the coming years. Tremendous potential. It's already being realized. Wealth levels across this region are rising significantly. Again, China, similar situation. Very diverse cities, some of the cities, you know them pretty well, are doing extremely well, and now we're seeing a lot of growth in what you would call the secondary cities, cities that are further inland, cities that aren't as big as the large cities in those countries. That's where a lot of companies, a lot of exporters are realizing a lot of their growth in China. Okay, so we made, wow, 1 o'clock. We did the whole 190 countries in 45 minutes. How is that possible? Hugh Jackson doesn't even know when to call a timeout when there's 10 seconds left to happen that night. It's 45. when I'm overseas a lot, so the Browns games come on at 7, and because I could buy the NFL package, but I wasted my money on Browns Super Bowl tickets, which would never come. The games come on at 7 o'clock at night, and I watch them with my kids, and they never show the Browns, of course, because they show 2 games, and then I have to watch the red zone, and it's just other teams scoring on the Browns time. It's really frustrating. It's really bad. Don't invite Browns executives when I'm speaking until they start winning. So let's get off the Browns. Let's talk about something positive. Summary, what do we take away? Growth is going to accelerate, but only slightly in over the near term. We're looking at a pretty decent 2018 around the world. Some economies doing better than others. Developed economies right now is the best time in the developed world since the financial crisis, in over a decade, since 2006, 2007, before we fell off a cliff in 2008. That'll continue for at least another 12 to 18 months, and then we're going to start to hit some headwinds in 2019 in the developed world. Asia, non-Asia, that gap between emerging markets is growing, and it's growing substantially. A lot of companies that we deal with are very bullish on places like Latin America and the Middle East 4 or 5 years ago, and that's the investments they made there have not brought much return in recent years. And geopolitical risk levels remain dangerously high and will remain so over the next couple of years. So that's my email address. If anybody wants to contact me, if you have questions that you don't think of now, or you have any questions about ISA, our company, or about this presentation, or about international markets, please feel free to drop me a line. And that's our website if you want to learn more about what we do. So I guess we have a few minutes for questions, no? Easy questions only, right?
Yeah.
That was easy.
Oh, and I will attach the slides to the calendar invite before I leave here
Oh, okay,
today.
well then.
So if anybody wants it, you can email me, I'll still send them to you, but they'll also be, if you go onto our website, onto the calendar invite for today, they're all the way down at the bottom. I will do it before I leave here, though.
So I don't have to send it.
So you don't, no,
Oh, okay.
you're welcome to, but I can go ahead and do that, and people can also email me, and I can send it, so. Okay, questions?
Yes.
Yeah, so it's a wonderful presentation, comprehensive, but what's the role of the rising inequality in most countries?
Well, it's certainly creating a lot of these political trends that we're seeing, that the working class that used to exist in many developed economies shrinking, and people not being able to earn the type of salary that their fathers and grandfathers or grandmothers and mothers and grandmothers earn, is having a major impact on this rise in protectionism, the rise in populism, both on the right and the left. And that's leading to these trends in terms of populationism, protectionism that we're seeing. And that could have significant impacts on growth over the long term if this persists year after year, and we see business confidence falter, we see investment and trade levels falter. So that, for me, is the biggest issue with wealth inequality. And it's growing. I mean, right now it's growing significantly, and it's very hard to discern how are we going to handle this issue. Countries don't have that much wealth to redistribute. It's very difficult to do that. Some countries are testing right now. You've seen these living wages, where people, even if they're not working, they get a small salary from the government. Finland's testing it. I think Switzerland, there's a couple of them. So everybody's trying to figure out how do we solve this issue of growing wealth inequality, but it's very difficult in the current climate.
You've given us a very bullish presentation, I think.
That's the first time I've heard that in years, by the way. Usually they've been so negative in previous years.
So, the obvious question is what could go wrong? Now, war, obviously,
Yeah.
is hopefully we won't have to deal with that. But is there enough capital to support the growth? Could this result in a much rise in interest rates, and capital will be allocated? It will be hard to grow at these rates if interest rates should double or triple.
Yeah.
That is double or triple from this level.
The economy has yet to prove that it can generate growth with higher interest rates. We've had low rates for almost a decade now, which is almost unprecedented. And as the U.S. is raising, as Europe is going to be raising interest rates, will the economies continue to do that? That's why we're looking at 2019. We're starting to see headwinds in those economies, and we're starting to see some drag down on growth. We think over the near term, yes, we're pretty confident over the next year to 18 months that we're going to continue to see close to growth rates where we are, upper twos, let's say, and in Europe in the mid to lower twos, but in terms of percentage growth. But by 2019, this is going to become a major issue, as higher interest rates are dragging on the economy, as spending starts to, the growth, consumer spending starts to falter, business spending starts to falter, then we're gonna see some issues definitely. I think over the near term, we're pretty safe. The one issue too, and we didn't talk about it, there's a real potential for gridlock right here, political gridlock in the US. We do not know what's going to come out of this Mueller investigation. Let's say this really becomes a big issue, and we start, Republicans are forced to decide if they stick with the president or not. We have a real risk of political gridlock in 2018 with the midterm elections coming up. I don't think it's going to, that's not going to resolve itself overnight. This is going to be a long process, but there is a possibility. And when we look at geopolitical forecasters besides ourselves, everybody is warning that that is one of the key risks in 2018, is that what is going to happen with the Trump administration this year and next year.
Could you provide some comments or insights on the South China Sea and what that means for trade globally, and if we reach the point where it's too late for the U.S. to do anything, and what the implications might be for that?
It does seem too late. If you know the South China Sea dispute, China has this 9-, which they amended to a 10- line, which they claim was once approved by the powers in the region. It gives China basically control over all of the waters, or 90+% of the waters of the South China Sea, which is perhaps the world's most important shipping lane today. They've been fortifying islands. They've been building up rocks that were under the sea, turning them into islands to give them more control over the waters around them. They're putting military bases and fishing fleets and everything in these waters. And for a number of years, the one thing preventing them from being too aggressive was the U.S. Navy, continually going through the South China Sea, enforcing their right to do so. If the U.S. continues to turn inward, there's nothing that China's neighbors are going to be able to do about it. Indonesia, Vietnam, the Philippines aren't going to be able to do anything to prevent China from really controlling those waters. For China, they have a clear goal, and they want to, they're kind of constrained that if they want to send ships out of China, there's an entire group of islands from Japan all the way around Indonesia that they've got to get through. And it's clear they want to dominate the waters between China and that first island chain. And that means controlling the South China Sea, the East China Sea, the Sea of Japan, excuse me. East China Sea, the Sea of Japan, right. They want to control all those waters. And that's the first goal. And that's why the South China Sea for them is so important. Second thing is they need all these commodities to run their economy. Where do they get those commodities from? From Africa, from the Middle East. So they need to control the shipping lane between where those commodities are coming from and China. And that means controlling the South China Sea. That means increasing their naval presence in the Indian Ocean. They're building naval bases, or they have deals on naval bases across in the Indian Ocean, in Sri Lanka, in Myanmar, in Pakistan, and in Kenya or Tanzania, one of the two. So they have, they're really moving aggressively to protect their shipping lane. They're developing their Navy rapidly. They just launched a second aircraft carrier. They're relatively non-advanced aircraft carriers yet, but their goal is clearly to have a blue water Navy that can challenge the U.S. Navy in the waters around China. So that's a very important issue that we're watching going in.
The flattening of the U.S. yield curve is getting a lot of attention. How predictive is the flattening of yield curves globally or in other countries of an impending recession? And I guess what are the signs as we enter this ninth year of the U.S. expansion? What are your signposts you're looking for that could, aside from rates, that could
that's really what we've been looking at, and we're seeing what's happening here in the U.S. being replicated, not to the extent that some of the valuations here in the U.S. are, but definitely we're growing increasingly concerned that we're getting to that point. You look at where the curve is now, we look at some of these other valuations, every single time that this has gotten to this point, something bad has happened within the next 24 months. Every single time. And that's what we're looking at right now. It's being replicated everywhere. Investors, stock markets around the world are going up. They've been going up, but in many cases they're now irrationally, is that the right word to say? And we think consumer spending, business spending is going to be pretty strong over the near term. That'll help companies to record decent numbers, but as that starts to slow into 2019, investors are going to suddenly look and say, wait a minute, this isn't what we expected. That's why, again, one of the main headwinds we're looking at for 2019. Yes.
So the thinking behind the tax cuts is you're gonna free up capital that will then be invested in projects that, for reasons of whatever, have not been made to this point.
Right.
Is there a way that economists can look at that and test, how do you test that hypothesis, whether that seems to be true or not?
But do you mean true that they will do it or they should do it?
Or that there are these investments that are just waiting for more capital to become available at lower rates than are
Yeah.
available now?
Well, I mean, as I mentioned with infrastructure, that's certainly one we think that without major investment in infrastructure, there's gonna be an increasing drag on the US economy. It's not just US, infrastructure around the world is in need of investment, in Europe, in Asia. But if if we don't get that increase, and this is a good opportunity to generate some of the funding for that increase, or for that spending on infrastructure, there's going to be a long-term drag. So I think there's undoubtedly a benefit there for us to pursue that policy. And I think the assumption initially was with the tax cuts is they were gonna go hand in hand with such type of planning. But there's been no talk since the election about what we're gonna do with infrastructure, what we're gonna do to create jobs. But there's been the tax cut plan, which has now been approved by both houses. But as far as, is it quantifiable, the benefits? I think so. I think if you look at things like shipping costs and how much time we're losing with logistical issues in the United States and in countries like Germany, we can absolutely quantify it.
In terms of infrastructure?
Yes, that's the one I was focusing on.
So similar type question. So it didn't sound like the tax cuts have a big impact on US growth. What about the stipulation about for appreciation of capital spending? Do you have any projections on that adding to growth?
We don't have an actual projection. It would provide some benefit, of course, but we're kind of, for me, an issue is with the tax cut, where we are in the cycle right now. We are kind of at the top of our cycle, and we're gonna be sliding. So these tax cuts, when they do come in, are gonna come in at a time of spending is starting to slacken. So it may prolong growth a little bit, but again, that could then lead to an even bigger, that could have a bigger hit in 2019 as far as the fall is concerned. Have you done if you had enacted these in 2019, for example, when we expect us to be at a different point in our cycle, probably would have made more sense, but since when is this making any sense?
I probably should know this. Could you talk a little bit about your organization, about
Sure.
ISA,
Okay,
and how you gather your data?
sure.
It's an impressive presentation, and it's, I'm kind of curious
Okay,
about
well,
how you do that through organization.
Yeah, we were founded in 2003, and when we started the idea, we were going to be an economic forecasting firm and a consulting firm. We would help companies investing internationally or building factories, and it quickly changed into one. We do two things now. We produce hundreds of publications, from country reports to economic forecasts, risk forecasts for all 190 plus countries around the world. So that's one of our businesses, this publications. People subscribe, companies or individuals subscribe to everything we publish. So we have everybody from major multinationals like Coca-Cola, Microsoft, to governments, to universities. The other thing we do are advisory services, where we tell companies where to invest. Like, for example, the NBA is a big client of ours, and every 2 years or so we do a major look at all the international TV markets and places where they should be holding events internationally. And so the business is really publications and advisory services. As far as getting our data, we have a system where we are looking at so many sources of news. Top line news on an international basis, then country by country we have what we consider our reputable news sources, which unfortunately is an ever shrinking number these days. The trend isn't just here in the United States where the media moves far to the right and farther to the left. That's something that's been going on around the world. We have what we think are very reliable sources of information and news that we can trust, and and if they are biased, we can read through the bias. But yeah, it's a huge process of gathering all the information for these 190 plus countries that we follow. Thank you.
Do you have a firm view on any market-based oriented reforms going on potentially in China over the next few years? Or do you think it's more rhetoric?
Right now, I think it is a bit of rhetoric, but I think there's an interest in Beijing to attract even more investment, as they're going to be fighting against debt, as They're going to be trying to bring that down and reduce some of these bubbles. I think there are other parts of the economy that are going to have to offset that, the losses that incurs. But it remains to be seen. Honestly, not much of an idea of what they will actually go forward with, and they haven't been very clear about what they will, at least that we've seen. All right. No Cleveland Browns questions? Will they win a game this year? Is that, anyone think, is that one game, Christmas Eve again? Chicago Bears, they could win that. Maybe, it's the day before Rodgers comes back.
Does Rodgers win back?
No, the week after, so maybe,
With a chance to.
yeah.
You should take part in your investment in the money you save for the Super Bowl, if the Cleveland Browns do that, it's gonna be a long time to grow.
That's true. Should have been invested in Bitcoin. $12,000 now, yeah. Or not that Venezuelan petrol. Okay, well, thank you very much for your attention.
Thank you, Michael.